I think Peter Lynch said that if you're 6 out of 10 correct, you're one of the best managers out there. I've been a lot more correct, so I'm kind of waiting for the time when I'm not going to be correct.
So it's not all gut feeling, it is data driven.
Absolutely, yeah, you have to be data driven because you can't go to an audit committee or a board and say, okay, I have a gut feeling that, we shouldn't be investing in X, Y, and Z. So I think this is a golden time where, you can take advantage of the fund flows, the euphoria around India growth, and taking advantage of the futures being priced in now. US and India are different markets, right? The US raised rates by about 525 pips. India raised by I think 250, about half, right? So we're never going to see the same interest rate moves as you're going to see in the US.
Hello and welcome to Financial Architects, Crafting the Future of Indian Business. I'm your host, my name is Tanisha Nair Dhawan. Have you ever wondered what plays on the minds of money managers of big companies? How do they de-risk the business and invest short-term surpluses? In this series of shows, we will catch up with chief financial officers and treasury heads of leading Indian companies to find out their spending and investment mantras. Please welcome Mr. Anuj Chandra, head of Treasury and Investments, Hero Motocorp, who is joining us on the show now. Welcome to the show, Anuj. Thank you so much for being with us.
Yes, thank you, Anisha, and thank you to Tata as well as Mint for inviting us over for this interview. Your values, your leadership, and your governance is completely in sync with our values too. So thank you for recognizing us, and we look forward for this interchange.
Anuj, we all plan, and suddenly, sometimes plans don't work. So how do you balance this sudden thing that comes up, sudden challenges that come up, with what you have planned for the long term?
Yeah, that's a good question. So for that reason, you don't put all your eggs in one basket, right? So when you're talking about investments, for example, right, you divide up your investment in buckets, things which you might need for short-term needs, things for medium-term and long-term, and you balance it. So for example, in our investment mantra, we look at safety of principles. In other words, we don't want any capital loss. Secondly, you look at liquidity, which is very important. We fund the liquidity of the company. And the third is returns, right? So you have to balance all three. And if you do it in a proper way, then all those contingency expenses or your not planned for outflows will completely be taken care of.
Did you do this much of planning and deciding when you got your first paycheck? How was that like?
Yeah, so good question there. So, I've been at Hero for about 5.5 years, right? And it's a company which is, rich in cash, right? But when COVID did hit, right? A lot of the corporates in India were kind of, hit with that paradigm of illiquidity, etc. But we kind of, we plan it out so again that we were in a good position so we could actually redeem our investments and kind of take care of whatever we needed. My first initial foray, so I'm talking about in India and Hero, we had no issues. But in the past, when I had my prior job in the US, we had a lot of issues, especially during 2008 financial crisis, where we were stuck with illiquid investments we couldn't sell.
So I want you to jog your memory back to your first paycheck. When was it? How much was it? What did you do with it? Did you think about investments at all?
Yeah, no. So you're talking about my own personal spend here?
Yeah.
Okay, yeah. So I have not been a good personal investor.
I'm not talking about your experience now. I'm talking about your first paycheck. I remember my first paycheck was just 10,000 rupees and all of it went to the bank for a whole year. I spent nothing because I had no time to spend the money. So I want you to jog your memory back to the first paycheck.
Okay, that was a long time ago, but I was in New York City, right? And I had an apartment there. So a lot of my paycheck went into paying the rent out, right? Business school loans, which again was another big kind of, use of cash. So nothing was saved. Nothing was saved for quite some time, couple of years actually. A lot of it into school debt, etc.
But do you think that works now? Why I'm asking is because post-COVID, people have started perhaps investing more, or if they're trading, whatever, they have become more cognizant of how their money can be financialized and hence money can work for them. But when your paycheck is thin, what should you do? Should you, immediate spending has to be done, but do you then, crimp on your lifestyle and invest, or do you just make the most of what you have?
Yeah.
How do you think, for us, we were brought up with different values. Gen Zs and millennials have different values. How do you see it happening now?
Yeah, so I think you should be saving, And that's really important in my view, at least, because you never know when you won't have a job, or when you have to change your job, you have to change your location. So I think saving is very important. Put in an SIP, or put some portion of your paycheck under the mattress. So maybe 20%, 25%. But I think saving from day one is really important, because if you compound that over a 30, 40-year career, you can make significant amount of returns or net worth build up. But you should start from day one if you can. Now again, everybody has separate or different circumstances. Like you might have parent obligations, you might have school debt, so you can't probably do that. But the moment you can begin to save, you should start doing that. Sooner the better.
All right. Now, you have years of experience. So when you're managing money, I'm sure you're cool, collected, you understand. But what is your leadership style for those younger in your team? When there are volatile situations, when there's something that has happened which is not according to plan A, but you have to come up with a plan B, and they are not ready with a plan B. So what is your leadership style to take them along, explain to them, to see that they don't lose the shirt?
Yeah, so a lot of the younger kids haven't been through cycles, right? So having a 20-year, 25-year career, especially most of that in the US, I've gone through the 2000 tech crisis, right? 2008 financial crisis, the spike in credit interest rates, right? Bankruptcies, right? There was Enron, there was WorldCom, there were all those huge bankruptcies, right? So you've learned over cycles that everything is not one way in terms of going up, in terms of markets kind of increasing every day, right? So you have to go through some of those cycles to manage your expectations, your investment style, and so you kind of diversify. That's the basic mantra out there, and you do your bottoms-up research to figure out where problems might arise, and you try to anticipate some of that. But to kind of invest saying that, okay, if you put it in say asset A and that's only going to go up, I think that's the wrong way of doing it. So a lot of my time is actually spent in teaching the younger kids what these cycles are all about. And maybe it hits you every 7 years, 8 years, especially in India. I mean, there was a bear market in the fixed income 2 years ago, right, when interest rates spiked about 200 bips or 225 bips in India, and over 500 bips in the US. That year, none of the mutual funds made actually money, which had any kind of duration. So it was a bear market in fixed income, right? So they've gone through that already recently, right? And there's a lot of learnings from that also. So I think the mentality is changing. But business schools and need to kind of do a better deal in kind of preparing the younger folks as to how to deal with business cycles.
Okay. Once you explain the cycles, how do you explain risk management, and how do you see your risk management style? Do you think it is ultra conservative, or less conservative? And how do you manage this during different cycles? And can you teach this to your team?
Yeah, so I have been a senior credit risk officer at Citigroup in New York, so where we managed the entire bank's technology, media, telecom exposure globally, and we went through a lot of ups and downs during that time. So I've had a lot of experience in risk management, in credit risk management. So when you look at fixed income portfolios, right, which is really where the risk is for treasuries, because most of the assets get allocated fixed income, there are two kinds of risk. There's credit risk, where companies actually don't do well, spreads have increased, or they might actually file. Or the second is interest rate risk, right, where rates actually go up, and then all of a sudden your bond prices come down from 100 to 90, right, just because of interest rates. So the two risks you have to manage, right? So it depends on where you are in the cycle to kind of put on a hat of conservatism, or you want to go full-blown risk, right? For example, right now we're in a situation where rates actually are going to be heading lower, right? So should you be thinking of duration risk, because now that risk has really gone away, or is much less versus what it was about a year ago, right? Should you be more focused on credit risk? I think yes, because there's a lot of money out there chasing a lot of companies which may not be cash flow positive for years and years and years. So should we be actually putting a lot of money in AA names? I don't know if that's the right time to do that now. So depending on where you are in the cycle, whether you want to put on a credit risk hat or a duration kind of risk hat, it kind of depends where you are.
But then you do guess, the second guess at least, the timing of...
Yeah, so that's where the value comes of a portfolio manager or a chief investment officer like myself, is you have to do bottoms-up research. You have to be well read. You got to follow market trends, and you have to have a gut feeling as to where you want to kind of put your risk.
So it's not all gut feeling. It is data driven.
Absolutely, yeah. You have to be data driven because you can't go to an audit committee or a board and say, okay, I have a gut feeling that we shouldn't be investing in X, Y, and Z. It has to be backed by some data, some history, and some kind of views forward looking. That is.
All right. So you initially mentioned that you have different buckets. You have a plan for the short term, the medium term, and the long term. Now, seeing our economy and seeing fast growing companies like yours, you can see strong growth coming in the future, and you feel that even if now is a little not so strong, it is coming. So you are planning for the future and putting something for the long term. Do you ever think that maybe I should move something from the near term and it isn't going that good and move it to the long term? Because I want to understand, how do you balance the risk management with your long-term growth strategy? Because sometimes you may just feel that I'm going to get more bucks there. Should I just put everything there?
Yeah, that's a good question. So if you look at the yield curve, right? If you look at the 5-year versus the 10-year, it's kind of flat. So do you give yourself any advantage of going 10 years versus going 5 years? In this environment, no, because yield curves are flat. Typically, yield curves tend to be steeper. Right, so if you're getting 30, 40, 50, 60 bips more for putting long term versus short term, you might do that, right? Especially in this environment because duration risk is not there right now. So yeah, so you kind of look at also liquidity then. So some of the longer tenured bonds may not be as liquid as shorter tenured bonds. So if you know for sure that you don't need cash for say 2-3 years, you might put some of that in longer end. But you want to do it for 20 bips, for 5 bips, for being flat on the yield curve? Not for us. But again, if you're an insurance company, for example, you're managing your yield versus your assets, then you might want to reduce your reinvestment risk by locking in a yield for longer term. So it depends which company you're in, what you're doing. But for us, like I said, liquidity is very important because the industry is going through, as you know, is very volatile, goes through cycles. So liquidity is number one, and we don't want to lose any capital. And if you do those two, returns would follow.
All right. Now, you've given me some examples of, and you have such a wide experience of having worked abroad, now in India. You spoke about the financial crisis. Do you remember an incident of your work life in India where you took a bet and it didn't go your way?
Oh, that's a good question. I can't think of that explicitly in terms of not going my way. I've so far been lucky that everything I've done has gone my way. But I'm sure I'm going to hit a road one because
so
you
your
can't
gut
really
feeling has been working.
Like, I think Peter Lynch said that if you're 6 out of 10 correct, you're one of the best managers out there. I've been a lot more correct, so I'm kind of waiting for the time when I'm not going to be correct. So I think it's going to come down a pike, but I can't really think of one big example where I've been wrong. Of course, you're wrong on smaller things, right? But on a big kind of investment decision, I really can't kind of think of an example.
If not an investment decision,
yeah.
Can you tell us of any real life example of what a challenge it was for you and how you found your way around it? Say maybe in COVID, because COVID was something nobody planned for, and you did briefly talk about how you had the foresight to cash in. A lot of people did. Right. Anything about a challenge that you didn't foresee?
So one challenge I can think about is just before COVID hit, there were some funds which were not kind of marking the books accurately. So when we look at a fund, for example, we look at the bottoms of research. We look at every issuer in a fund and we try to do our own analysis of the fund. We look at fair value, relative value, where the bonds are trading at, are the bonds marked correctly in terms of pricing. So we saw some mismanaged pricings within certain funds, right? And we sold it. And thankfully this happened before COVID hit, like a couple of months only before, I think it was January or Feb. So when COVID actually happened, those funds became very illiquid. People couldn't get out of it. But we were in a good place there because we had actually pre-sold it, not because we thought COVID was going to happen, but just because we saw some pricings which were not kind of accurate versus where we thought some of these bonds should be trading.
So you got saved?
I got saved. And I got a lot of these examples of what went right, but not that many what went wrong.
It's interesting, most of your bets have worked and you've been right 6 out of 10 times. But when COVID came, people thought कि हो गया, देख लिया हमने VUCA world क्या होता है. But after that, it hasn't stopped. You had the Russian war, which still goes on, surprisingly. Nobody can believe it, it's still on. You got problems in the Middle East. And it seems that business is back to normal. So how do you assess what's happening around the world, and why isn't there fear? What has led to the fear going away?
Yeah, so a couple of things. like you said, effects of COVID are still lingering on, especially in the supply chain, right? It hasn't come back to normal.
Oh, it still hasn't.
It hasn't come back to normal. There's certain pockets of supply chain disruption still happening, right? Geopolitical risk has had an impact everywhere, right? Towards spending by governments to, people being more nationalist, has had effect on tariffs, on trade wars. So that's actually happening, right? You have the presidential election in the US going to happen. That's my change policy everywhere, right? Inflation is just about getting abated. So we saw 2 years of very high interest rates, right, which kind of killed off a lot of demand plus a lot of buying power of people all over, right? So again, those are all kind of not good things for the market, right? But the market kind of bounced back really fast, right? And the idea being there is there's a lot of surplus money in the hands of the consumer because of not being able to spend for 2 years, which is now going to make its way in the economy. And that's actually happened and happening, right? And now with the supply chain becoming a bit better in terms of visibility, right, and you're seeing now inflation being more moderated, interest rates going to be cut down, the idea now being that there's going to be demand coming in, right? For example, in India, we've not seen two-wheeler demand go back up to pre-COVID levels, right? So there's a lot of growth still to come there because you haven't even reached pre-COVID levels right now. So those are kind of the and then the story is obviously different, right? Because of the 6.5-7% growth rate, and there's a lot of capex being put by the government, infra development, all that's going to pay off over time, right? So there's going to be years and years of earnings growth coming down the pike, right? So all that optimism being built in right now. So rightfully and wrongfully, markets are separate because valuations are very stretched. We know that, right? You have to go 2-3 years forward PE to kind of justify any company right now, especially the small and mid cap. But valuation is one thing, but growth is something separate, which is, I think, going to happen over time.
So you're saying in India, because the visibility of growth remains strong, there is no fear?
There is fear in terms of valuation. You've got to pick and choose where you want to put your money, right? If you go and buy, for example, defense stocks, which are up 400% over the 2 years, I mean, you're kind of, coming in at a very high level. You're going to be kind of exposed, right? If you bought it 4 years ago, you're going to keep holding on to it, right? There's a lot of SIP money coming in, which is kind of putting a base or bolstering some of the investments coming out there. FPI money is going to come its way into India now because of the interest rate cuts, which are going to happen, making India more attractive, right? You've seen JP Morgan putting in Indian fixed income into their indexes. That's going to drive in a lot of money into the bond market. It's already happened, but you're going to see $1 or $2 billion more of money coming in every month for the next, a year. So those are drivers which will support markets in India. But I think you've got to pick and choose. You can't really put your money in a passive fund, for example, and think it's going to do well. You have to actively manage your money. So some of the quant funds are going to be good. Some of the more actively managed funds are going to kind of perform better.
And how do you see global money flows? Why I ask is because there are a lot of different things happening with central banks. Yeah, you see UK and the US, they're cutting rates. But Bank of Japan raised their rates. Right. So, what happens to the global fund flows, and what kind of impact do you see it happening in our country when we are expecting the RBI to slow down or come off the gas pedal when it comes to interest rates? Because some people still feel that inflation is a risk which is not out of the woods yet.
Yeah, so I kind of agree with you on that the US and India are different markets, right? The US raised rates by about 525 pips. India raised by I think 250, about half, right? So we're never going to see the same interest rate moves as you're going to see in the US,
but
right?
I'm talking about differential. Now, if differential isn't much, I mean, I might as well stay with the US, right? But now the differential is going to,
Right, so that's what makes India markets more attractive then, right? So as the US already cut 50 bips, I think there's going to be another 50 bips by year end, so 225s or one more 50 bips. So differential is going to decrease, making Indian markets more attractive, right? Because the carry trade is more favorable, right? So you're going to see money come into India from that perspective, right? But will the RBI cut? I think they're going to have a wait and see approach. Inflation is still moderately high in India, right? And don't forget, you have two presidential candidates who are both big spenders in the US, right? So if they come in and start doing a lot of spend, you might see inflation even creep up in the US again.
So
nothing is straight line from here. So you have to really play it safe. Do you really want to increase duration risk so much that you're comfortable that rates are going to go back 100 bips down in India? Are you comfortable with that view? So if you are comfortable with that view, how do you kind of balance the risk versus reward from that perspective? So there's a lot of important movements of money which is going to happen even within treasuries. Where do you want to allocate your next rupee coming in? It's very interesting times right now.
What about things like investments for technology, specifically say for the automotive sector, because a lot of new things are coming in. And yes, we have seen consumers also spend for these new features, but you will have to put in, as an automotive company, investments into something that may not have a near-term payoff. So how do you manage, how do you predict that this X amount is good enough if we want to get something new or first mover thing in the automotive industry?
Yeah, this is not my personal view, by the way, not necessarily speaking for Hero, but we are doing that. I think every auto company has to kind of put money in technology, because the product itself is becoming a technology product, right? Especially with the move to EV, right? When you're going to do everything which an iPhone can do, you can have a connected device like a two-wheeler do that, right? So increasingly enough, you have to put money in your systems, in your maps, in what your vehicle can deliver to the battery management, battery charging infrastructure, range, all of that is coming in, which we never thought of it before, right? Yeah. So from an IC engine, simple pistons model, you're moving into a tech product, right? So you're going to have its own challenges. You got to put in more money in there. And again, we think that the payoffs are going to come off again over time, because again, EV is only just a few percentage points of the entire market, and we're going to take time for it to kind of ramp up, but it will ramp up.
All right. So, I understand investments, whatever you have made, planned or otherwise for technology, because it obviously pays back into your business. What about things like sustainability? Because, net zero is a goal and we can't get there unless industry also does its bit. But you may not see the near-term payoff, because sustainability, you will sink in capital investments there. Right. So how do you view those kind of investments which may not have tangible benefits in the near term?
Yeah, so for that you really need to look at whether the CEO or the chairman of a company believes in sustainability. Like at Hero, for example, we are way ahead. All our plants are almost towards our goals to go net zero, right? We have water harvesting, we have green plants, right? Renewable energy, right? Recycling, right? Even in the corporate offices, right? We have zero plastic. Even in the bathrooms or washrooms, we don't use paper towels anymore to dry our hands, but we actually use air dryers. So simple things like that. And if you go to our website, you'll see a lot of other things which we've tracking on a real-time basis and what we've actually guided to. I think we're way ahead, and I think management at Hero does actually really believe in the environment, has strong empathy for the environment, and we're doing our best to kind of be at the forefront.
So I would think that since you have started earlier than many other companies, and a lot of smaller companies thinking of to start doing this, what's your advice to them when they are looking to invest into sustainability? Because one thing is that there is no way out. So far, the smaller companies don't have to report, and they don't have to do it. There's no stick there. It's only a carrot. So you've been doing it for so long. What's your advice to them when it comes to investing for sustainability?
Yeah, so I think every company has that responsibility to the society to do it. You can do it through CSR spends also, right? If you have a CSR spend, which you have to, why don't you put it towards sustainability? There are lots of different ways of doing it, but if you just measure everything with ROI immediately, you're not going to get the right return. But over time, where you kind of, benefiting the environment, your kids, healthcare costs come down, living standards become better, there's a lot of payoffs towards the tail years. And I think it's kind of, definitely a responsibility of every corporate and every citizen to actually go that route.
But you feel proud that, hey, I'm in a company that is responsible. You're profitable, we're good, we're best in the industry, and sustainable. On a
no, I'll take that, but I think we've really worked hard towards those goals.
Now, I want to try and understand a little bit about you also. Do you play sports, or do you have other hobbies? And does it help you anywhere in your work or your investment decisions?
So I'm a very big tennis fan and play a lot of tennis also. That's one of the things I do. Then that's my passion on the sports front, right? Okay. I don't play 5 sports, I play 1 sport. And I do watch my Netflix shows. I love watching TV. I read sometimes, but weekends is over time when I don't want to take work back home. So I really believe in work-life balance, and I think everybody should do that, right? And I think everybody should do that. So it's a time to chill out with family, with doing your other outside work interests, travel a bit, And that's where I am, and it helps me concentrate and get back into full-blown, work mode come Monday.
Okay. So when you play tennis, what do you think, are there any learnings from tennis in the real world, in not just business, say in the real world? Because, there's a study that shows amongst all sports played, if you play a racket sport, you will live the longest. And it's not because your legs are moving around, it's because you have a cognitive jog every day with your hand-eye coordination.
So I did not think of that, but I think
You're happy you live longer?
Exactly, I can eat more sugar now. Think I'm going to live longer. But what does work with, obviously, is concentration, right? Number one is concentration, right? Number two is learning from your failures, right? I can never get the backhand correct, and most of the time improve my backhand. You work towards your failures or your shortcomings, right? Those are two big learnings, I think. And then also you learn, you play with a couple of folks, right? So you talk about networking, you talk about, having a good time socially. So that's also very important, right? So obviously the exercise is positive. You have your learning from your failures, your concentration, and this kind of, you learn from all that stuff.
But now that I've told you, you have a good chance of living longer. Right. So do you think you're going to tweak your retirement planning now? Perhaps you're going to have to change it because if you're living longer.
I'll leave that to management. I'm not on that. I don't have much to say there.
I'm trying to understand your
but
personal
I do
style.
believe in working longer. I don't think that, especially in the investment side, right? If you look at Warren Buffett, most of the investors, they work in the 80s, right? Because you learn more from cycles, right? It's one of the few specialty jobs which becomes better as you get more experience, right? You don't need a 20-year-old would not be able to perform as well as an older person because you have gone through the experience, right? So I think it's one of those professions to be in where you can actually chug along for longer than other professions.
So I'm trying to understand your personal style of investing. Now, if you know that I have to live longer, should I be doing more for retirement planning, or you're saying you're
I'm not big into, I like being more personally a bit more aggressive on my investments, personal expenses, right? Investments, right? So for example, I'll do things which can double in 2 years.
But why?
Right?
Why?
Because I feel that, again, to my point, I feel that this is the time to invest a lot in India if you can. Because a lot of the good news is going to be priced in the next couple of years. Because like I said, things are expensive, but pricing in years and years of growth. So when 4 or 5 years comes from now, you're not going to get the same moves in the markets because you've already realized all those gains before. So I think this is a golden time where you can take advantage of the fund flows, the euphoria around India growth, and taking advantage of the futures being priced in now. So I think this is the time to actually be more risk, even though you might lose money in my view. But if you are confident, if you can get the right stocks, there's no harm in kind of punting right now.
Because people feel it's already too euphoric. You don't think that is?
I think it is euphoric if you look at the entire market. But there's so much value still out there. There's still companies who can double from these levels, right?
But you got to work hard.
You got to work hard. You got to work hard. You got to read the annual reports. You got to talk to management. You got to do your own homework. But there's always that opportunity out there.
Okay. So in your personal style, you're at this point of time taking more risk.
Yeah, I have taken more risk in the last couple of years. I did not take any risk, but now I realize that I'm late in the market, so I have to be more selective. But I'd rather be more risky now than not kind of having missed the euphoria the last couple of years.
What do you say to the millennials who have not seen a down cycle? They've only taken risk and they've only seen the upside. So
yeah, so for those guys, it's all SIP. If you're doing SIP, you don't have to worry about that because that mode of investments takes care of the downs and the ups, and you average in and you get an attractive kind of return over years. But you got to start early if you want to take advantage of that.
Okay, and do you believe in systematic investments, or do you think timing, getting it right, that is more important?
I believe in SIP, but I don't believe in doing one SIP in a month. I would scatter it over 3 or 4, like one a week. So if you have, say,
so you're de-risking.
Yeah, if you have 100 rupees, you divide up into 5 weeks or 4 weeks and put 25% each of the 4 weeks. I think so. SIP is not only monthly. I think it should be weekly. I mean that diversifies it more in terms of timing.
Okay, and anything that you would like to say to your peers, because everybody's heard it, you're right 6 out of 10 times, and you feel that on a personal level, risk is something that if you can afford it, you should take it for the near term.
Right.
But for people who are managing large amounts of money for their companies, any advice to them?
Yeah, so my biggest advice would be that be sure what you're investing in, understand the risks around that investment. the upside and the downside, right? And write down on a piece of paper, like when do you want to actually exit that investment. If you don't, right, then well, that's really important, because if you're up 10%, you might get greedy and say, I want to be up another 10%, but you might get down then, right? So you have to have thresholds, in my view at least, both on the upside and downside. If you're not disciplined about that, you can err. So I think that's very important. Understand the risks really well, and you can't blame anybody. The blame's going to be on you. So do your own due diligence, your work, read the research reports, understand the business, the values where where your fund is or your bond values are. Do relative value comparisons. If you think of buying 5 bonds, think of why you want to buy bond A and not bond B. Right? What is the extra? Is the risk you're taking worth the 25 bips you're getting from a high yield? You got to understand all those nuances, right? And the more you understand the business, the valuation, you read the annual reports, hear the earnings calls, etc., you get more comfortable, right? And always be disciplined about it. Why you want to invest, why you want to get out, and what levels you want to get out.
All right, and write that down.
And
you forget about it.
I do that sometimes. I've not been that disciplined now, but when I initially started off, I was actually writing down.
So you feel that one should have a target, and once that is met?
Absolutely, yeah. Now if you buy a bond at say 7.5% yield, right, 2-year, 3-year bond, right, and tomorrow the yields go down at 7% or goes to 6.5%, do you want to keep holding on to the bond? Right, so there has to be some discipline around that. Otherwise, you'll be sucked in to a investment which is not going to give you enough returns given the risk you're taking.
But then somebody say, "देखो आपने क्या किया, आपने क्या सोचा था, क्या हो गया?" You took the right decision to cut your losses when it was not too much, but people will fault you.
No, that's fine though. Otherwise, you could have lost more.
Okay.
So you have to, right? And again, it's a portfolio concept, right? You might make losses in one investment, but net is what really matters, right? I mean. Even all of us do treasury investments. My calls haven't gone right, but net is all right, right? So I'm not going to say I've lost a couple of lakhs here, but I've made a lot more other investments. So net you kind of become okay. But what really helps is if you have a discipline of knowing when to kind of call it the shots and move on.
All right. Thank you so much for speaking with us, Anuj. It was very enlightening to understand how your investment style is working, and good luck to you. Not just 6 out of 10, I hope in the future it's 10 out of 10.
Thank you very much, and appreciate it, and thank you for your time, and thank you to Mint as well as to Tata. Thank you.
So that brings the curtains down on Financial Architects Crafting Indian Business. Do stay tuned. We'll be coming up with subsequent shows, and we'll bring in more managers to understand their investment style. Stay tuned.